Hi, Matt.
Hi, Rogerio.
Hey, nice to reconnect again after this pandemic.
Great to see you.
Great, great. Matt, today I really want to catch up with you to see a little bit about how and if your thinking on long-term real estate investments has changed as a result of this pandemic and on day 2 of Freedom Day, after Freedom Day.
Yeah, no, it'd be great to catch up. My thoughts on long-term investing, it remain pretty much the same. Sure, there's been some impact. There's certainly been some acceleration of the megatrends that we've identified, and there've been some changes, but really the megatrends to investing in real estate remain in place.
Sure. Just since there are some people that probably are not familiar with your thinking, do you want to kind of sum up the reasons why you look at megatrends as opposed to what, frankly, most of people do, which is the short-term demand and supply analysis?
Yeah, sure. I actually have a slide which I think would be helpful to share with investors, and it certainly influences the way that I think about investing, and especially real estate investing. Real estate is probably the longest duration asset out there. If you buy good quality real estate and if you lease it well, you can lease the real estate for many decades to come. So with that long-term viewpoint, then if we look at the REIT market, Gravis has done some proprietary research into the returns, and if you look at the UK REIT market over the last 10 years, you've made really some quite good money. But what's really interesting is that if you tried to time the market, if you missed out on just 10 days, if you missed out on the 10 best days in the REIT market, then your returns would have essentially halved. So we think it's much better to take a long-term approach to investing in a long-term asset. And then within that, I think you can really identify some megatrends that are at play. And the megatrends that we think are really strong: aging population, digitalisation, generation rent, and urbanisation. So pick the big megatrends. Look at the evidence that staying invested generates the best returns, and then search for the best companies within those megatrends.
But as an investor, what is my time frame? What type of time frame should I set myself? Are we talking about 5 years, 10 years, 20, 50 years? Where do I really see the outperformance of being invested in the right megatrend relative to just market index?
Yeah, so you can start collecting your outperformance very early on, but for that to really come through, to really collect the fruits of your labor, stay invested for the whole economic cycle and beyond. Some of the most successful property investors out there have been investing for decades, and in fact, some of them are multi-generational owners of real estate. So when you're thinking about investing in real estate, think about it for the long term. Think about the contractual nature of that income. Your tenants are signing leases. In some cases, certainly with the case of big box logistics facilities, they're signing 20-year leases. If you think about care homes, they're signing 20-year leases. So that lends itself for the underlying investor to think in that sort of time frame, think in terms of the medium to long term. It really does have a place to play in a multi-asset portfolio. And I share this slide with you now. Look, if you look at 10-year asset class returns, the past 10 years have been in an environment where central banks have been very liberal with their balance sheets. Their balance sheets have been expanding. There's been quantitative easing. Interest rates are very, very low. So unsurprisingly, the prime beneficiaries of that type of liberal monetary policy have been corporate bonds have performed very well, gilts have performed very well, but also real estate equities over the last 10 years in the UK have performed very well. They've outperformed the UK equity market. And what's really interesting to me as a real estate investor, real estate equities have outperformed direct property funds. And then when you think about that, when you look at the performance and ask yourself, well, why is that? Part of it is leverage. Real estate equities, REITs, typically deploy in the UK, typically deploy about 30% loan to value, whereas the traditional direct property funds, the large diversified funds, actually had a cash drag. They had about 20% cash. That was non-performing cash. So that hindered their performance. If you adjust for that, real estate equities have still outperformed. And then the question becomes, why is that? And hopefully, as we go on to discuss, I'll show you that it's because they increasingly own the best quality real estate out there. The other important thing to note that you see on this asset class returns chart is that real estate equities have really outperformed inflation. And in the financial press right now, there's lots of talk, lots of commentary about the resurgence of inflation. It's important to note that real estate equities are not fixed income. This is growth income. This is income. If you pick the right subsectors, if you pick the right megatrends, this is income that will grow with the economy or grow with those megatrends.
Oh, understood. So do we want to talk a little bit about this key megatrends and your views?
Yeah, sure. So to set the scene, if you drill down into the performance of UK REITs, which have performed very well, and you look at the performance over the last 10 years, what's performed the best? Self-storage. Self-storage is the likes of Big Yellow, Safe Store. These are owner-operators of real estate assets. And I think that's an important point to highlight to viewers, that real estate is migrating from the old traditional landlord-tenant model, the old model of let and forget. And we're moving to a world where real estate is a service. We're moving to a world where it's a landlord-customer relationship. We're moving to a world where you're an owner and an operator of the assets. And you certainly see that in self-storage. Over the last decade, industrial has done a fantastic job at migrating from oily industrial to big box e-commerce fulfillment centers, and also to last mile distribution facilities. Residential, and we'll come back to this hopefully, residential is really growing, both in terms of purpose-built student accommodation and in terms of the build-to-rent market. So really good trends over the last 10 years. What's been the nightmare area? Retail. So the beneficiary has been e-commerce has driven industrial, but e-commerce has also hindered, hampered, hurt the retail space, and you see retailers perform very poorly. If you look in the UK over the last 12 months, very, very similar trends. So self-storage continuing to do very well, industrial continuing to do very well. And on the poorer end of the spectrum, retail, a little bounce with the reopening of the UK economy, but really still underperforming. If you then take those performances and you put them in the context of the mega trends, at Gravis, we like to think there are really 5 key themes at play within the real estate sector. So the first key theme that's at play is aging population. Developed countries, and the UK is no exception to this, developed economies, the population is aging. We're getting older, and as we get older, that puts more of a demand on our healthcare systems. And then within that, GP surgeries and residential care homes are really a prime beneficiary of that mega trend. When you look at digitalisation, digitalisation is all about the growth of e-commerce. In the UK, 30% of sales now, of retail sales are online. That's driven a huge wave demand for an investment in e-commerce fulfillment space and last mile distribution space. And also, really interestingly, and we saw this on the previous slides, self-storage. There's a part now, an element of self-storage that is basically, it's the e-commerce fulfillment for small online businesses. Small online businesses need somewhere to store their goods, need somewhere to ship them from. They rent a small amount of space from the self-storage companies. It's a really interesting dynamic at play. Urbanization. To Gravis, our view is cities are really the land of opportunities. And within cities, offices represent the space in which collaboration, creativity takes place. So I think as economies reopen, people will return to cities because that's the land of opportunities. They will return to the office because that's where creativity takes place. But they'll want to return to safe offices, COVID safe offices. They'll want to return to offices that are environmentally friendly. And who owns those offices is typically the REITs. Generation rent, it's all about housing and accommodation. It's about renting high quality, purpose-built accommodation. And the mega trend to avoid on the changing consumer behavior is retail. As we come out of this pandemic, I don't imagine there'll be many retailers saying, what I need is a bigger store footprint. I don't imagine there'll be many retailers turning around to their landlord saying, I'd like to pay you more rent. Actually, I think what they'll be saying to their landlord is, I can't afford to pay you the current rent. I'm going to have to pay you less rent. So they're the 5 key themes that we see taking place in real estate.
Understood. Now, yeah, exactly. Drilling down to some of these themes. If you can elaborate more.
Sure. So look, generation rent, for example. So if we look at generation rent, I think there are 2 types of assets that investors can look at. There's purpose-built student accommodation, and there's the build-to-rent sector, both of which are really attractive. These are tenants, occupiers, taking a proactive view that they want to rent purpose-built space. And if you look at the demand and supply drivers for purpose-built student accommodation, for example, in London, when we come out of the pandemic, when students return to universities, and we have some of the best universities in the world here in the UK, and within London, we have Imperial College, we have the London School of Economics, we have University College London, so some of the top universities in the world, more than 400,000 students per annum in London. But purpose-built student accommodation, the supply is only 100,000 rooms. So really good demand outstripping supply imbalance, leading to good, in normal times, good rental growth. So I think that's a very good dynamic at play. Within aging population, on the right-hand side of this chart, you can see the classic population pyramid with the bulge moving its way up the age axis. And in the UK, the over 85 population is predicted to double to 3.2 million by 2041. And what's interesting about that is when you're over 85, you tend to go and visit your GP far more frequently than if you're under 30, for example. And we know that going to see the GP, going to see your doctor in a GP setting is much more cost efficient than going to see a doctor in a hospital setting. So there'll be a massive wave of investment in primary health facilities, in upgrading those facilities. And again, if you look at the UK REIT space, there are a couple of REITs that specialize in offering primary health facilities. And with that, there's also a big demand for residential care homes. So care homes for the elderly, and again, a couple of REITs that specialize in that area. They own the assets and then partner with the operators of assets. So really good growth trends taking place. Within digitalisation, another one of our key megatrends, you can see on the chart on the left-hand side that online sales as a percentage of total retail sales has jumped. You asked me very early on about how my views changed. They haven't really changed, but the pandemic has certainly accelerated the shift to online sales, above 30% online. In the US, it's accelerated to above 20%. In continental Europe, we're moving to the mid-teens. So that's great news for the owners of warehouse space, because online retailing requires three times the amount of warehouse space compared to traditional retailing. You need somewhere to store your goods, to pick them, to pack them, to ship them, and to accept returns. So big demand for space. And then Gravis cautions investors about investing in pure retail. So many names on the right-hand side have faced administration. So high street names, they go into administration. Who's going to take that space? It's not obvious to me.
Yeah, actually, this is a good point. If we want to, when an investor wants to implement these key views, what is the approach to the security selection? Yeah,
great question. So security selection is something that we at Gravis spend a lot of time on. So in the UK, we're fortunate that REITs, real estate companies, their assets get valued by a valuer. But for us, that's only the starting point. And investors, I think it's important for investors to remember that the valuation is just an opinion. It's not a statement of fact. It's a valuer's opinion on what those assets are worth. And in a market where property prices are increasing or rising, for example, within the logistics sector, it's likely that the valuer is going to lag the current market prices. Market prices are moving much faster than the valuer can put in their model. So be aware of that. Use the valuation as the starting point. And then recognize that valuers ascribe no portfolio premium. And by that, I mean, a collection of individual assets is worth far more than the sum of those parts. And we can evidence that by looking at the takeover premiums paid for REITs. And you can see that in the footnotes, Blackstone bid for Handstone and paid a 12% premium for those assets. So the investor should think about, okay, what's the premium for that collection of assets? And then, as I touched upon, as we move from the old landlord-tenant model, as we move into a more modern model, property as a service, and a model in which your landlords are both owner and operators, operating platforms become really super valuable. And the brands, so if you think about self-storage, Big Yellow has these self-storage facilities. They design them, they build them, they operate them, they brand them Big Yellow. I think it's absolutely fantastic idea. It's hard to implement. And then they have a digital front end. So they control the leasing of the property. They control the discounts they offer. They can influence the leasing velocity. That's a super valuable platform. Property valuers don't reflect that in their valuation. And then moving to the second row of our approach to valuing, management matters. If you look at the track record of management, those REIT management teams that have created value in the past are more likely to do so in the future. Valuers ignore the balance sheet. Valuers are just looking at the assets. I encourage all investors to look at the balance sheet. History will tell you that low leverage is better than high leverage. High leverage coming into a pandemic, forces you to do a discount rights issue. High leverage, you risk bankruptcy. Low leverage gives you opportunities to go and buy new assets, gives you opportunities to do development work. And then development platforms. This is really an evolving area, and there's some great academic research that's just come out from Professor David Geltner at MIT, showing that development platforms really add to superior returns for REITs. And so I encourage investors, look for great assets, identify the megatrends, look for great assets, look for great management teams, and then look for those that have exposure to to development platforms.
Understood. And on this point, yeah, exactly. If we can move to the digital infrastructure, because when we look at megatrends and the long-term outlook, is probably this is one of the most fundamental transformation that we are going to experience. What do you see here as the subsectors worth investing?
Yeah, I think you're absolutely right. I mean, of the megatrends that we map out, the most exciting of the 4 megatrends is digitalisation. And then when you look at digitalisation, there are many ways for investors to play it. So within digitalisation, we look at digital infrastructure companies, and within infrastructure, there are communication towers. So they own the towers in which communications equipment's hung off. There are data centers. So these are the buildings that house the servers that enable the internet to happen. There are networks, the fiber optic networks that connect all of the data centers together. And there are logistics assets, so big box e-commerce fulfillment and smaller urban distribution facilities. What links communications, data centers, networks, and logistics together is contractual leases. So these are real estate assets, medium to long-term leases, contractual rental income. I think that's a very interesting area to look at. There's another part of digital that has very different characteristics. So software, hardware, and payment systems. Their business model is much more a transactional revenue business model. So very different to contractual leases with high cash flow predictability. And then you touched upon this. We're in a world of change, and we certainly agree with that. We're living in the 4th industrial revolution. And in the UK, look, the first industrial revolution was mechanization in the late 1700s, steam engines. In the late 1800s, we had the second industrial revolution, so mass production. Electricity entered the production revolution. In the 1960s, we had the third industrial revolution, automated production, computer-powered, robotics entering the factories. And right now, we're living in the 4th industrial revolution. This is all about new technologies. It's about artificial intelligence, big data, cloud-based computing, the Internet of Things. A really exciting time. And this revolution is changing our lives. So it's changing the way that we work, the way that we play, the way that we live. And clearly, look, this conversation that we're having right now, we're both in 2 different places. The presentation is stored in SharePoint. The communication is taking place via Zoom. This requires a new type of infrastructure. It requires data centers. It requires digital networks. The way that we play has changed dramatically as well. You know, certainly in my family at the weekend, no longer do we watch movies in the physical format. You know, no longer do we buy a DVD. We download our movies from Netflix. When we listen to music, we're streaming from Spotify or Apple Music. And increasingly, me and my family, we're doing it on the move. And this requires telecommunication towers, it requires 5G networks. And then the way that we live has dramatically changed. So the way that we shop, we're all Amazon shoppers now. And my family pointed out to me at the weekend when they were on my Amazon account, and I was staggered by this. I have been an Amazon shopper since 1999. And now, you know, it's just part of what we do. We're all Amazon shoppers. And in the UK, the pandemic accelerated that move towards online grocery shopping. And this requires a new type of infrastructure. It requires e-commerce fulfillment centers. It requires urban distribution, last mile distribution, same day distribution facilities. So across that spectrum of digital infrastructure, I think there are great opportunities to be searched out. So 4th industrial revolution, changing the way that we live, work, and play, and it's created this perpetual data cycle. So data drives the creation of more apps. More apps creates even more data. More apps and more data requires more bandwidth. And so it keeps going. This perpetual data cycle is in motion. New technologies are coming along, smart homes, semi-autonomous, autonomous manufacturing. And the next explosion in data is going to be autonomous vehicles. When autonomous vehicles come along, they're going to create huge amounts of data. It has to be processed, it has to be transmitted. Big demand for digital infrastructure. And you can see that if you look at the data out there, if you look for the evidence, if you look at the volume of data is forecast to grow by 30% per annum over the next 3 or 4 years. And e-commerce sales, I've talked about the UK and I've shown a chart of the UK being at more than 30%. If you look at the US, e-commerce penetration as a percentage of total retail sales now up through 20%. So the analysis shows you that these trends are really firmly in place. And so we talked about the mega trends of aging population, urbanization, generation rent, digitalisation. As we move from the analog world to the digital world, within digitalisation, you can see these different sub-trends and the characteristics that they have. So communication towers, they lease space for communications equipment. Average unexpired lease term of the REITs that we look at, more than 7 years. Who's the customers? Mobile network operators. Data centers, they own the space in which we put the servers. Average unexpired lease length, more than 5 years. Who's the customer? Everyone. It's everyone now. We're all storing stuff in the cloud. Individuals are storing pictures in the clouds. Businesses are storing the documentation in the clouds. Governments are storing everything in the cloud. So everyone is a user of the data centers. Fiber optic networks, different lease lengths depending on whether it's metro area fiber or whether it's subsea cables. Telecoms companies are the big leases of that space. And then within logistics,
it's interesting that they lease it. They don't they don't actually own it anymore. I mean, they are relying on providers, direct providers to lay the cables.
So there's interesting dynamics taking place. There's certainly some of the big FANG companies, so the Facebooks of this world, the Amazons of this world are buying cables. They're wanting to own. They've identified them as being so important that they're owning their own cables. So if you can get hold of cables now, I think there's a chance they become a scarce commodity. So it's an interesting area to invest in. And then you see with logistics, big facilities. And I recently visited Amazon's largest e-commerce fulfillment center in Europe. It's at Dartford, just outside London. £200 million building, fantastic building. The value of the equipment, the value of the robots they're putting inside that building is rumoured to be £400 million investment inside the building. They've signed a 20-year lease. To investors, you get 20 years visibility. A great tenant, Amazon, 20 years visibility, and the lease is linked to inflation. Minimum uplift 1%, maximum uplift 3%. Really interesting real estate.
So really interesting to hear your thoughts, Matt, and certainly lots of ideas to think about it and to ponder as we allocate our portfolios in the next as the economies reopen and we hopefully return to normality.
Yeah, I think you're right. I think there's lots of opportunities out there. I think real estate is probably moving faster now than at any stage in certainly in the last century. This whole wave of new types of real estate coming along, whether it's e-commerce fulfillments, whether it's data centers, whether it's purpose-built student accommodation, lots of specialist real estate coming along, lots of opportunities for investors to look at.
Indeed. Well, It was nice to talk to you again, Matt.